All right, good morning or good afternoon, I should say. Welcome back to the channel. Today, we are going to be talking specifically about something in the pension world. This video is going to be pertinent and interesting, well, relevant to you if you're age 55. So, I've got a couple of asks. If you're age 55, you're going to want to perhaps maybe just take some notes, get a pen. But also, if you know someone who's age 55 thinking about taking their tax free cash, in fear of what might be coming down the line in the autumn statement on November 26th, then please share this video with them. I'm just going to show you the headline that we're going to be covering in terms of the article, and this is in the Telegraph. So it says here, pensioners, pension savers told they cannot reverse lump sum withdrawals ahead of the budget. Now, we actually covered this last year. As you know, there's been a lot of speculation around the kind of tax changes that might come in this statement. It was the same last year. And last year, there was a concern that there was going to be a reduction to the tax free cash that you can access in your pension when you hit 55. I'm going to scribe to show you the numbers and explain the impact of taking tax-free cash from your pension as a holding. But I think it's just important to paint the picture of where we are right now. So what's effectively happened is since last year, with all the speculation that was around back then, people had taken out a lot of money, and people are doing this actively right now. And the idea was that if you took your tax-free cash from your pension, you would have a 30-day cooling off period. We are now getting clarification from HMRC and from the FCA that if you take in your pension commencement lump sum or your tax-free cash, you cannot go and put that back into your pension. And obviously that has implications. So let's just start with what the article is telling us. And then what I'm going to do is I'm just going to scribe and explain the numbers behind this and the potential implications that it has for you on your pension. So let's just go down here. And it says pension savers will not be allowed to return their lump sum and reinstate their tax-free allowance despite previously being told they had a 30-day cooling off period, the Telegraph can reveal. HMRC is expected to confirm its position this week amid a surge in lump sum withdrawals following reports that Rachel Reeves, the Chancellor, could target retirement pots in her autumn budget. Now, this is the same speculation that we had last year, only it was one that didn't come to fruition because she didn't decide to change this specific thing. So I've mentioned tax-free cash, pension commencement lump sum. You probably don't know what that means. So let's go over to my scribe and we're going to just break down what it means and how it effectively works. All right, so you probably understand the idea that if you have your pension, and I'm just going to put a rectangle on the scribe here, okay? That's not a very good rectangle. Let's start again on that one. I want to make sure it's actually straight. Okay, let's call it a square, all right? So this is your pension, okay? And under the current tax rules, let's just say you have £100,000 in your pension, you can, at the age of 55, start to take in a lump sum or in withdrawals or in stages, however you please, 25% of the value of that pension pot. So in other words, if you have £100,000 in a pension, you can take £25,000 tax-free, either as a lump sum, as withdrawals, or as a set of lump sums over a period of time until you hit that £25,000 limit. Now, your pension commencement lump sum or your tax-free amount is capped. So the maximum you can take from a pension is £268,275. It's quite a lot of money. This kind of aligns with a lifetime allowance, which is about £1,000,000 at the moment within your pension. The maximum you can have in your pension without having to pay additional taxes. So quite a large sum of money. Now, what has happened is over the last year or so, where there has been speculation that this might be something that Rachel Reeves tackles, people have been actively taking money out of that pension once they hit 55 to be able to prevent perhaps a reduction in the limit. Now, the reduction that was mooted and is still really, to be fair, being mooted is that £268,275 will be reduced to £100,000. So it's £168,000 reduction. So if you've got a sizable pension and you're thinking, I can take this money tax free, pay no tax, bearing in mind that once you've taken that amount from your pension, everything else that you take then becomes taxable. It's almost a no brainer, right? You are effectively getting ahead of a potential tax problem. But with people doing this now in the run up to November 26, people thinking that this is something that she might address, we're now being told that previously, if you had taken money out, and this is the planning strategy a lot of people have thought about, they thought about, okay, if I take the money and I've got a 30-day cooling off period, if she doesn't reduce it to £100,000, I can just put that money back. This is where the confusion is. We're now getting the headlines saying that no, you are not going to be able to put that money back. So that's how tax-free cash and this whole idea effectively works. Okay, when we talk about what is being reported in the article, let's go back to the article very, very quickly. So that's what they're talking about. Okay, now they're saying that some pension providers previously promised savers a 30-day cooling off period after withdrawals with their tax-free cash allowance. The FCA are now saying that that is not going to be the case. The reason why they're saying that you're not going to be allowed to do that is because there are strict rules around taking tax-free cash, a lump sum from your pension, and putting it back in, i.e., recycling. Because there is a piece, if you remember, on your pensions. Let me just go back to the scribe here. In pensions, typically what happens is if you contribute, say, £100, right? You get tax relief on the way in, right? So that means that the £100, once you factor in your tax relief, you've only really paid £75 in because you're going to get the boost from the government. So if you're paying £100, you're getting tax relief. People have sometimes used the ability to take tax-free cash and put it back into their pensions to be able to get additional tax relief on the way in. So there's strict rules that allow or disallow people from doing that. And what they're basically saying is that the cooling off period is not going to apply. Now, if you come down here, this is an interesting graph. I just want to show you on the article here. This graph right here, it just tells you the volume of people that have taken money out of their pensions since Labour won the general election last year. So if you look at the chart here, so back in 2018, 2019, about £7.8 billion was taken in tax-free cash, right? You fast forward to 2022, 23, it's remained relatively the same. There was a jump in 23, 24. I would say to probably about, according to this graph here, call it 11, maybe 12 billion. The recent number is £18.3 billion. So people are obviously spooked here. And as I've already said, if you think about the fact that you've worked all your life to amass this pension, and let's say you have a sizable amount of money, the ability to be able to take 25% tax free in either a lump sum or withdrawals, however you wish, knowing that you have to pay income tax on anything else that you take after that tax free lump sum has come out, then obviously, from a tax planning point of view, it makes sense to do so. It just so happens to be the case that I think a lot of people have jumped the gun in this equation here, where they've looked at it, thought, I'm just going to go and get the money out, and then I'll have to deal with it. They're now being told that if you do this in the run up to this year's autumn statement in November, you're not going to have the 30-day cooling off period. So you can't put that money back in. Now, is that going to put you in a disadvantaged position? Potentially, because look, where are you going to put the money, right? This is where we have to talk about tax planning. I'm just going to go back to scribing here, right? So let's just say, you had significantly more than £100,000 in your pension pot. Okay, I'm just going to go big here, right? And just say, let me just get rid of all of this here. I'm just going to go big here and say that you had £1 million in your pension pot. All right. And I'm doing this purely just to get to the big number, bearing in mind the limit is 268,000. At £1 million, you can exit 250K out of your pension completely tax free. You can do with that whatever you want. You can go buy a Lamborghini if you wanted to, right? But the issue you're going to have is this is now outside of a tax wrapper, and a pension is effectively a tax wrapper, right? So you've got £250,000 now sat in cash of some kind, right? In an account somewhere. The issue that you're going to have is you can't go and put 250K into an ISA because your limit on an ISA is £20,000. So where you put the money, you can put £50,000 into NS&I premium bonds, but at that level, you're not really scratching the sides. So let's just say it's 70K maximum. You've still got £180,000 potentially sat around in an account that you're going to have to pay interest on. And so, whilst you've skirted on one side, getting the money out tax free, you've actually taken the money and it's now sat in a tax bearing environment because there's very little you can get into ISAs, things like premium bonds. The other thing that you could probably do would be to start looking at things like EISs or VCTs, venture capitalist trusts, those types of things. But those don't come without their own risks. And you have to hold it for a period of time before you actually get your tax back. I think for a lot of people who may find themselves in the situation where they are part of the people that have withdrawn 18.3 billion quid, with this news now that you can't put that money back in because it's going to effectively be a contravention of tax rules. I think that there is potentially going to be some financial planning that you need to do. And look, this is where I'll probably end the video in just saying, look, if you're in this position right now, you've got a sizable pension, and this is something that you've been thinking about doing ahead of the autumn statement because you're not too sure what she's going to do. We don't know whether she's going to reduce it to 100 grand. She might not. If she does, sure, you're going to be disadvantaged. But the point of the conversation is this: you probably need to go and take some financial advice. I know YouTube is helpful. I know YouTube is a really good source of information. I am a qualified a financial advisor, but I've not advised for some time now. And I'm not really in the realm where I could even advise you on this in the guise of coaching. I can't. I can give you an explanation like this in a little bit more detail because of the information you'll provide me in my process, so I can actually pinpoint what you can take and where the issues might be, but I can't advise you on this. The best thing you can do is go and see a financial advisor. Make sure that if you are going to take a sizable amount of money out, that you're going to have a place for it to go. That's going to be really important. And whether or not it goes into NS&I premium bonds, or you split some of this into an ISA, the added benefit that you are going to have with this is if you are married, you've got to be a little bit careful here, and it depends on how your assets are split. But on an ISA, at least you can do times two, right? So you can put 40K in the tax year for you and your missus, you and your partner. And to be fair, you could probably do exactly the same with premium bonds, assuming you've not already used your full allowances anyway. So let's assume that you've done nothing, right? You've not used your ISA allowances and you've not maxed out your NS&I premium bonds. The maximum you could get in out of 250,000 that we're talking about here would be about 140K. It's still going to leave you with £110,000 to do something with. So look, go and seek some advice if this is something that is going to be a worry to you and you're trying to figure out what you do. You've got to go seek a financial advisor to help you, because they are the guys that will help you plan this and advise you on where you can put it in line with your own goals and your own personal circumstances. I know it's not something that often people want to hear. Go see a financial advisor, but the reason why wealthy people can do what they do is because they take advice. So if you've got a sizable amount, you should take advice. That's all I'm going to say. Anyway, hope you enjoyed this video. If you did pick up some value, please be sure to like the video, because number one, it's going to mean that the algorithm will take that as a nod that you've enjoyed it, share it with other people. And if you did get value as well, consider subscribing, hit that notification bell. It will just tell you when I next upload another video like this. Let's have a chat in the comment section. What do you think about this? Is this crazy? Are you in a position where you thought this is what you're going to do? This has now kind of maybe made you stop in your track and think a little bit. I hope it has. I'll see you tomorrow. Cheers.